Welcome to The Explainer. Today, we're diving into the really complex and honestly pretty contradictory signals coming out of the U.S. economy. And right at the heart of it all is a huge growing divide inside the Federal Reserve about what on earth to do next.
You know, this one line from Bloomberg just nails it. It perfectly captures the drama playing out right now. You've got the country's top economic minds looking at the exact same data, and they are coming to completely different conclusions. Nobody can agree on the right path forward.
All right, so to make sense of all this, we're going to walk through 4 key chapters. First up, that big disagreement happening inside the Fed. Then we'll get into the core debate, to cut interest rates or not. After that, we'll see how the market is reacting with this record-breaking dash for cash. And finally, we'll talk about the risks we all need to be watching out for.
Okay, let's get right into it. The whole economic puzzle really revolves around the officials at the Federal Reserve. You know, the people setting monetary policy for the whole country. And right now, they're not just divided, they are openly, publicly disagreeing with each other. It's pretty wild.
So on one side of the table, you have officials who are basically sounding the alarm. They're looking around and saying, hey, these interest rates are just too high. They're squeezing the economy way too hard, and we need to ease up before something breaks.
But then you've got another group looking at the very same data and seeing a totally different picture. They're saying, whoa, hold on. Inflation is stubborn, it is not defeated yet, and our job isn't done. And they're willing to accept some economic pain to make sure it's stamped out for good.
And just to make things more interesting, there's a third group kind of in the middle. Their take is, look, we're almost there, inflation is basically beaten, we're close enough to 2%, so it's time to shift our focus and protect the job market before it's too late.
So the key thing to get here is that this isn't some small technical debate. No, this is a fundamental split on what the biggest risks facing the U.S. economy even are. One side is terrified of a recession caused by high rates, so they're all about jobs and growth. The other side is terrified of inflation coming back to life. And that deep, deep divide leads us straight to our next big question.
And here it is, the multi-trillion-dollar question everyone's debating. Should the Fed cut interest rates to give the economy a boost, or should they hold firm to finish the fight against inflation? The thing is, the answer really depends on which story you think the data is telling.
Now, what's so interesting here is how this timeline just lays out the whole journey. Remember that scary, rapid ramp-up in prices? Then you see the turning point in late 2022 when the Fed acted. But look at 2024. Progress is totally stalled out. We're just kind of stuck. And that's the sticking point that's fueling this whole debate.
And this slide just perfectly lays out how divided the outside experts are, too. On one hand, you have analysts saying the economy is strong enough to handle rate cuts. But on the other, you have folks pointing to models like the Taylor rule, which is basically a formula for setting interest rates, and saying, hey, none of the math says it's time to cut yet.
Okay, so the Fed's divided, the experts can't agree. What are big businesses doing in the middle of all this uncertainty? Well, they're making a huge move. They're borrowing money at a pace that is truly historic.
Get this. In September alone, sales of high-grade corporate bonds are on track to hit $200 billion. Just to put that number into perspective, that's a level that's only been crossed 4 times in market history. It shows a real, genuine rush to lock in financing right now.
So what's driving all this? Well, it's not just one thing. Part of it is that September's always busy, but companies are also being really strategic, jumping on a recent dip in borrowing costs. At the same time, investors are starving for these bonds, and the whole thing is getting supercharged by the AI investment frenzy, which, as you know, needs just massive amounts of cash.
And if you want a poster child for this whole trend, look no further than Oracle. They went to the market for $18 billion to build out their AI stuff. And the response? It was absolutely overwhelming. They got $80 billion in orders. That just shows you how much cash is sitting on the sidelines looking for a place to go.
Now, all this activity, the strong economy, the record borrowing, it can make you feel pretty confident. But, and there's always a but, it's really important to look at the pretty significant and kind of hidden risks that are bubbling just below the surface.
One of the biggest dangers that analysts are starting to talk about is something called idiosyncratic risk. It's a fancy term, but all it really means is the risk that a single company, one that looks totally stable on the outside, suddenly runs into big trouble and collapses, catching everyone completely by surprise.
And this isn't just some theory from a textbook. We're actually seeing it happen. Analysts are pointing to the sudden, really unexpected troubles at big firms like Tricolor and First Brands as a major warning sign. It shows that even when the overall market feels strong, individual companies can just blow up without warning.
So, what's the big takeaway from all this? Well, you'll want to keep your eyes on a few things this coming week. A government shutdown is a big wild card. It could leave everyone flying blind without key data. But the real main event, the one thing that could change everything, is the U.S. jobs report coming out next Friday.
So, we're at a crossroads. The data's telling two different stories. The experts are on opposite sides of the fence, and companies are out there making massive bets. That jobs report, it's the one piece of information that just might have the power to cut through all the noise and maybe, just maybe, force the Federal Reserve to finally pick a side. Thanks for joining us.